Ladies and gentlemen, welcome to Wealth Tom. My name is Norbert BM, and in today's episode, we're going to do a stock analysis of Walt Disney Corporation. They just reported earnings, so we're going to go over their earnings first of all. Then we're going to take into consideration a couple of technical aspects of the stock, and then we're going to do a risk assessment in order for us to evaluate, is this a buy, a sell, or a hold opportunity, especially for the long term and the short term. Okay, so let's get started with Walt Disney. They just reported earnings. I'm going to go over the key aspects of their earnings report. You can find the earnings report in the link in my post on Substack that is down in the description as always. So let's get started with the earnings report. So Walt Disney Company today announced its financial results for the fourth quarter and full fiscal year 2024. The company delivered strong performance. Their earnings were exceptional across its various segments, driven by combinations of strategic innovations and of course robust consumer demand. Now, a couple of key highlights from their revenue there. It was increased by 6% for the Q4 of this year to $22.6 billion and a 3% for the full year to $91.4 billion. Now, their income before the income taxes declined by 6.0% to $0.9 billion in the first quarter and increased to 59% for the full year to $7.6 billion. The diluted EPS increased by 79% to $0.25 in Q4 and more than doubled to $2.72 for the full year. Now, let's go over the segment performance. So they have entertainment, sports, and experiences. By experiences, the parks is meant by that. So entertainment, strong performance driven by successful theatrical releases like Inside Out 2, which I did not enjoy as much as Inside Out 1, and Deadpool versus Wolverine, which I pretty much enjoyed. I'm a big Deadpool fan, also entire X-Men fan. Of course, Wolverine is one of my favorites. So sports continue to grow into domestic ESPN advertising revenue, and of course experiences, record revenue, and operating income for the full year with strong performance and domestic park and experiences. Now let's take a look at their guidance. That was one of the best guidance they had for a long time. They guided for high single-digit adjusted EPS growth for the fiscal year 2025 and double-digit adjusted EPS growth for the fiscal year 2026. Once again, double-digit adjusted EPS growth for the fiscal year 2026. And this excited the markets. Continued to focus on improving profitability in its streaming business. So they're trying their best with Netflix, their biggest competitors. Okay, now let's talk about the CEO, Bob Iger, who is still CEO. They brought him back and he did make a couple of good changes. So he expressed satisfaction with the company's performance and highlighted the strategic effort to enhance quality, innovation, efficiency, and value creation. Because before that, the value creation was pretty bad. He emphasized the company's strong position in the industry and its commitment to delivering exceptional entertainment experiences for the consumer. Now, once again, the entire report is a 25-page report, but we'll read through it if you want. It's on my blog. The link for it is on my blog post. All right, now let's go over a couple of stats. So the market is still open, and Disney, after they had their reported earnings, they jumped a bunch. Full disclosure, we owned Disney and we sold it a couple of weeks back. If you're following my weekly reports, my weekend reports, we're going over the portfolio, what we sold, then you already know this. But for the rest of you, so we sold Disney, and today actually we made a trade on Disney. I'm not disclosing my trades normally, but it's already done. So we bought it, we sold it, and that's it. It was just a short trade. Okay, so let's do a technical analysis on Disney. We can see that it's pretty much overbought. RSI is overbought. MACD is on an extremely strong buy signal, and this will reverse also. We can see that today's candle went up to $114 a share, and it's already down at 110. So it didn't feel the candle. It came back down again. So let's do a risk assessment. For this, we're going to take into consideration the RSI. RSI, it's over 80 currently. Actually, it's 85. And we're going to take this as a high risk for the market, for the current stock price. Then the MACD is, now let's calculate this. The MACD is currently on a strong buy, which is also a very high risk. Then we have our EPS. Then we have our PE, which let's quickly calculate the PE. So we got a share price of 109 divided by the EPS of 272. So that's a 40. Now a 40 for a roughly market PE, a average PE is in 15 and 25. So let's just say we're in a bull run and this is a growing company. So let's take 25. We're going to subtract 25 from 40, and then we're going to divide it by 25. I just multiply it. So divided 25 and once by 25 by 25 and once again divided by 25. So this is 60% because if you multiply this, 100. This is 60% over its normal PE. So we are at 40, which is 60% over a 25 AVG PE. And we're going to categorize this as a high risk. You could also say it's a very high risk because 60% is up there. But if it would be somewhere roughly 80 or 75, I would categorize it as a very high risk. So we're going to leave this as high risk. Now, for the earnings report, as you saw, they did report exceptional earnings. So good earnings, and also their forecast was exceptional and forecast. So we're going to say that this lowers the risk for the price. Now, they also announced share buybacks, but for the fiscal year 2025. So buyback 2025. I'm going to evaluate this as medium risk. Now, overall, the stock market, take a look at the S&P here, is pretty much overbought and it's trying to come back here. So market overbought. And we're going to say that this is a high risk because there's a correction coming. Even if it is a small correction, it is coming. And this is going to pull down everything. And now let's take a look at its analysis. The forecast for the stock is, all analysts say it's currently 0.85, which is just worse than a normal market performance. So we could say that year-to-year return would be 1%, which is less than 8%, the normal market return. So we're going to add here very high risk for Disney. This is just awful what kind of return they were they're forecasting now. So with this returns, well, there's no buying here for the long term, or less not for the next year. Although they did forecast better returns. So we will see. But this is why we're doing our risk assessments. Now, they do return dividends. Let's take a look at their dividends. They newly restarted their dividend. It's at 0.73% payout. Well, they didn't pay anything out right now. So we're still working on it. They have a dividend. It's really, really weak. And let's see how. I'm not even going to take this into consideration. They don't have 1 year of dividend, although they did announce that if their revenue grows, then also their dividend payout rate will grow. Okay, so I would say that taking a look at this, at the 75% risk, I wouldn't buy Disney at this moment. Now, if it has a good enough pullback, maybe it is a good decision, but let's go back to Disney. But at this moment right here, Disney is not a buy. If you have Disney, then consider taking some profits. Now, once again, this is not financial advice. Please consider working with a financial advisor for stuff like that. But this is just my analysis for the short term. Disney is not the buy for me. Okay, hope you enjoyed this video. If you did, give it a thumbs up. Also, subscribe to the channel if you're not already subscribed. I also saw a couple of comments that YouTube somehow unfollowed me for some of you. So just click that notification bell and subscribe to the channel. So definitely get my videos as soon as I release them. With this being said, I'm Norbert BM, wishing you a lovely day. Take care. Bye-bye.